Let's be honest. Most of us only think about oil when prices spike or shortages hit. Right now, the American oil industry is facing a crisis, not from war, but from a global market battle. The question, who controls the world's most critical resource? The answer will impact everything from gas prices to global power. For years, the US led the world in oil production thanks to the shale revolution. Our light, sweet crude was in high demand, making America a market titan. But as of June 7, 2025, that dominance is under threat. OPEC Plus, led by Saudi Arabia and Russia, is flooding the market, driving down prices and squeezing US producers. Imagine running the best lemonade stand, only to have a rival give away lemonade for pennies. Suddenly, your premium product sits unsold. That's the reality for American oil today. This isn't just a price dip, it's a calculated power play with global consequences. OPEC Plus is challenging America's dominance, and it's working. How did we get here? What does it mean for you? And where is this oil war headed? Buckle up, this ride is about to get bumpy. America's light, sweet crude, think of it as the craft beer of oil, was once our secret weapon. The shale boom made us a global powerhouse, with WTI Midland even setting global benchmark prices. For a while, US oil was the standard, and Cushing, Oklahoma, became a nerve center for world energy. But being the premium option has a downside. You're vulnerable when cheaper alternatives flood the market. Many refineries worldwide have upgraded to process heavier, sour crudes, the kind OPEC Plus is now pumping out. These refineries can turn cheap, lower-quality oil into valuable gasoline, making US crude less attractive. When OPEC Plus offers a truckload of cheap oil, buyers jump at the deal. Our expensive, high-quality product suddenly looks less appealing. The demand for America's light, sweet crude is evaporating, not because it's bad, but because the world found a cheaper way. The very qualities that made our oil special are now working against us. The global market has moved on. Meet OPEC Plus, the supergroup of oil producers led by Saudi Arabia and Russia. For years, they kept supply tight to prop up prices, but in 2025, they changed tactics. Their plan: flood the market and reclaim dominance from US shale. Since April, they've unleashed over 1 million extra barrels per day, with more to come. The goal? Regain market share by making their oil cheaper and more attractive than America's. By targeting US light, sweet crude, they're exploiting the fact that many refineries now prefer heavier, sour oil. The result? A global oversupply and collapsing price premiums for US oil. WTI Midland's price premium has dropped by 45% since March. When the market is flooded, buyers choose the cheapest barrels. Right now, that's OPEC Plus oil. American producers are left struggling to compete. This is a classic price war, and OPEC Plus is winning. The US is feeling the squeeze as its market share shrinks. The impact is immediate: lower prices, lost customers, and mounting pressure on American oil. OPEC Plus is flexing its muscle, and the world is watching. The rules have changed, and the US must adapt or fall behind. The oil war is in full swing. The world is moving on from American oil, and it's not just OPEC Plus behind it. Countries like Brazil, Guyana, Libya, and Norway are ramping up production, adding to the glut. Buyers now have more choices than ever, and are no longer willing to pay a premium for US crude. Many refineries, especially in Europe and Asia, have retooled to process cheaper, heavier oil. For them, buying US crude just doesn't make financial sense anymore. US crude exports are falling, down 200,000 barrels per day in May, with Europe leading the retreat. European refiners are buying Kazakhstan's CPC blend and other grades better suited for gasoline. Analysts say demand for light, sweet crude is weak and getting weaker. The US built its industry on the idea that high-quality oil would always be in demand. But the market has changed. Buyers are price-sensitive and adaptable. The loyalty we counted on was just a function of market conditions. The world isn't ghosting US oil out of spite, it's just business. And right now, business is better elsewhere. In oil, it's all about price differentials. US WTI crude once commanded a premium, but since OPEC Plus opened the taps, that premium has vanished. WTI Midland's premium has dropped 45% since March. Light Louisiana Sweet is down 30%. The market no longer values US light crude like it used to. Global oil consumption is rising, but so is production, almost equally. The result? A well-supplied market that keeps prices low. WTI futures are stuck in the low $60s, with technical charts flashing warning signs. If prices fall below $62, analysts predict a drop to $59. This isn't a temporary dip, it's a structural weakness caused by a flood of non-US oil. Export data confirms the trend. US crude exports are down, especially to Europe. For years, US oil exports grew. Now we are fighting to keep what we have. Collapsing price premiums, oversupply, and falling exports tell a clear story. The golden age for US light, sweet crude is over. The numbers don't lie. American producers are in trouble. The market has spoken, and it's not in America's favor. The oil landscape has shifted. Why should you care if Texas oil barons are hurting? Because the effects ripple out to all of us. The good news, cheaper oil means lower gas prices, at least for now. But the downside is serious. U.S. shale is expensive to produce and low prices threaten thousands of jobs. If prices stay low, drilling slows, projects get canceled, and layoffs hit the energy sector. The boom that created jobs across the country could quickly turn to bust. Investors are also feeling the pain. Energy stocks are under pressure, and profit margins are shrinking. Wall Street is nervous and uncertainty is rising. Cheaper gas comes at a cost. American jobs, investment security, and the health of entire regions. The industry that made the U.S. an energy superpower is now under threat. OPEC Plus's strategy is working, and the U.S. economy is feeling the impact. Relief at the pump may be short-lived if the industry falters. The trade-off, a few bucks saved on gas for a lot of pain in the heartland. In the long run, that's a risky bargain. This is an oil war, a global chess match with supertankers as pieces and the world economy as the board. The U.S., powered by shale innovation, faces OPEC+, a cartel with vast, cheap reserves and a unified strategy. A decade ago, OPEC tried to crush U.S. shale and failed. American producers adapted and survived. But this time, the market has changed, and OPEC+ is playing the long game. The stakes are high energy independence, national security, and America's global standing are on the line. If U.S. production falters, we risk becoming dependent on foreign oil again. This is a fight for control that will shape the geopolitical landscape for years. Will U.S. producers innovate their way out, or will OPEC+ win this round? Watch WTI prices and export numbers. These are the front lines of the oil war. This isn't just about oil, it's about power and the future world order. The outcome is uncertain, but the consequences are real. The world is watching, and the next move is America's. The oil war is far from over.